everyone, it's Caitlin, and welcome back to Your Financial Journey. Recently, we've been seeing a lot of growth in technology and AI, and as a lot of you probably know, this has pushed up the stock market overall. So technology plays a big role in our economy overall and on the performance of the stock market. But how do we really track that? Well, investors who want to understand how technology stocks develop would usually track a specialized index, in particular the Nasdaq 100, which is one of the most widely followed tech-focused benchmarks in the US. To understand more about technology in the stock market, it's important to understand how the Nasdaq 100 works and what it is. So, today, let's dive deeper into it. What is the Nasdaq 100? What is its history? And what are its uses? Let's go! What is the Nasdaq 100? The Nasdaq 100 is a stock market index. Indices are essentially just a collection of some sort of asset that is used to track the performance of a wider sector or market. For the Nasdaq 100 specifically, it consists of the 100 largest non-financial domestic and international companies listed on the Nasdaq Stock Exchange. The Nasdaq Stock Exchange is the second largest stock exchange in the US, second only to the New York Stock Exchange. There are many similarities between the two. For example, both of them are based in Manhattan. But the Nasdaq Stock Exchange is unique because it was the first fully electronic stock market, and as of 2026, it's also one of the largest stock exchanges by market capitalization. The Nasdaq 100 takes the 100 largest companies from the Nasdaq Stock Exchange. However, these companies must be non-financial. For financial companies, there's the separate Nasdaq Financial 100. As a consequence, the main Nasdaq 100 is dominated by technology companies, although it does contain a few other firms as well, including from retail, telecommunication, biotechnology, healthcare, media, and services. And the separate Nasdaq Financial 100 consists of banking companies, insurance firms, brokerage firms, and mortgage loan companies. The exclusion of financial companies in the Nasdaq 100 is one of the reasons that the Nasdaq 100 is different from other indices, like, for example, the S&P 500, which usually do include financial stocks. So, what are the requirements for a company to be included in the Nasdaq 100? Well, first, its primary U.S. listing must be exclusively on the Nasdaq exchange. Second, it must have an average daily traded value of at least $5 million over the preceding 3 months. This metric is called trading volume and determines a company's liquidity. Liquidity is just how easy it is for an asset to be bought or sold in a market without affecting the asset's price. And third, the company must also have a free float of at least 10%, meaning at least 10% of the company's shares are publicly tradable. And then, of course, there are stocks that are completely ineligible even if they do meet these requirements. This includes not just any stock classified as financial, as I explained before, but any company that's classified as a real estate investment trust or REIT, and any special purpose acquisition companies or SPAC. The Nasdaq 100 is a modified cap-weighted index. This means that companies with a higher market value will have a greater impact on the Nasdaq 100 than smaller companies, which ensures that it accurately reflects the market. However, it is modified, which means that the index is periodically rebalanced to prevent overconcentration of specific companies and ensure more diversification. Specifically, caps and limits are applied to do so. For example, no single company's weight can exceed 24% of the index. And if stocks weighing over 4.5% make up more than 48% of the index in total, this will also cause a rebalance. At the time of this taping in July 2026, the top weighted company in the Nasdaq 100 is Nvidia, with a weight of 12.28%. Coming in second is Apple with 11.14%, and in third is Microsoft with 6.89%. These three companies tend to dominate the top of most indices, albeit with different weights, so it's not surprising that the same can be said for the Nasdaq 100. Other than that, other top companies in the Nasdaq 100 include Amazon, Alphabet Inc., the parent holding company of Google, SpaceX, which was just recently added this summer, Tesla, Meta, and more. There are currently 101 stocks in the Nasdaq 100 because some companies issue two separate classes of publicly traded shares. In this case, Alphabet Inc. currently has both Class A shares, listed as GOOGL, and Class C shares, listed as GOOG. The class of a share is categorized based on unique rights, privileges, voting power, dividend priority, or fee structures. Now let's look at the history of the Nasdaq 100. The Nasdaq 100 was launched on January 31st, 1985, 14 years after the creation of the Nasdaq stock exchange that it was based on. At the time of the creation of the Nasdaq 100, the market cap of the Nasdaq exchange totaled $58 billion, and it has since grown to over 80 times that size. The same day that the Nasdaq 100 was created, the Nasdaq Financial 100 also began its life, so the financial sector was separate from the rest from the very start. Both indices gave investors a way to measure how the biggest companies on the Nasdaq 100 were performing. There have been many changes to the Nasdaq 100 since 1985. For example, the base price of the Nasdaq 100 was initially $250. However, it was changed in 1993 to a base price of $125 after it closed near 800. The base price is the reference number from which the index is measured. Foreign companies were also initially barred from the Nasdaq 100 until 1998, when non-American companies were admitted for the first time. At first, there were higher acceptance standards for foreign companies, but this changed in 2002, when standards for foreign companies were lowered while standards for domestic companies were increased, so that the standards for both are now generally the same. Some foreign names currently in the Nasdaq 100 include the Netherlands' NXP Semiconductors and Canada's Shopify, among others. The technology sector has historically been the most important sector in the Nasdaq 100. This has led to some volatility in the past. Notably, the dot-com bubble burst in the early 2000s crashed the performance of the Nasdaq 100 for a while, exactly because of the heavy focus on the technological sector. In the 1990s to the 2000s, the earlier days of the internet, the Nasdaq 100 surged. But once the bubble burst, the Nasdaq 100 fell about 80% from peak to trough. Of course, the dot-com bubble did not only affect the Nasdaq 100, but because of the Nasdaq 100's exclusion of the financial sector, tech has a much greater impact on the Nasdaq 100. This has been both positive and negative. If the tech sector is booming, the Nasdaq 100 will rise more than other indices. But on the other hand, if there's a collapse like the dot-com bubble bursting, the Nasdaq 100 will be more severely affected than other broader indices. The Nasdaq 100 took around 15 years to fully recover and reach its 2000 record highs once more. However, recent developments in the technology sector have led to a lot of growth for the Nasdaq 100 in the past few years again, as I'm taping this video in July 2026. As I mentioned already, tech companies like Apple, Amazon, Nvidia, and Alphabet, or Google, have led to great returns for the Nasdaq 100. New technologies, like artificial intelligence, have also contributed to this, though some investors worry about a potential AI bubble burst akin to the dot-com bubble burst that we just covered. So, now that we've covered the history of the Nasdaq 100, let's look at its uses. As I mentioned earlier, the Nasdaq 100 is an index, an average of the prices of the underlying shares, which means you cannot directly invest in it. Instead, you must invest in mutual funds or exchange-traded funds, or ETFs, that track its performance by buying the stocks that make up the Nasdaq 100 in the same proportions as the index itself. The most popular ETFs for the Nasdaq 100 is the Invesco QQQ Trust Fund, which is often just called the QQQ Fund. Created in March 1999, the QQQ was the very first ETF created to track the Nasdaq 100, which has remained one of the most popular ETFs for the Nasdaq 100. The QQQ is highly liquid, so you can easily buy and sell shares, which makes it very attractive for many investors. QQQ also has about $490 billion in assets at the time of this taping, making it one of the largest and most heavily traded funds in the US. Another popular ETF on the Nasdaq 100 is the Invesco Nasdaq 100 ETF, or the QQQM, which was launched very recently in 2020. The QQQM and the QQQ consist of the exact same stocks, and both track the Nasdaq 100. The difference is that the QQQM has a lower expense ratio than the QQQ, with 0.15% versus 0.18%. The expense ratio is the annual fee you have to pay to cover operating expenses of the ETF. Other than that, the QQQM also trades at a lower price per share, at around $300 versus at around $700, and the QQQM is slightly less liquid than the QQQ. Thanks to these qualities, the QQQM may be more attractive for long-term investors because of its lower expense ratio and lower share price. On the other hand, the QQQ is preferred by active traders because of its high liquidity and trading volume. The average annual return for the Nasdaq 100 since its inception is roughly 14% to 15%. However, returns vary significantly depending on the year thanks to the Nasdaq 100's focus on the technology sector, as I touched upon before. This means that the performance and return rate of the Nasdaq 100 are highly dependent on what's going on with the technological sector, and big gains, as well as big losses, are more common for the Nasdaq 100 than other more diversified indices like the S&P 500. The dot-com bubble and burst is, again, a good example of this. From 1991 to 1999, the average annual return rate was 38% thanks to the growth of the technology sector. In fact, the Nasdaq 100 had a return rate of over 100% in 1999. But then, once the bubble burst, the 2000s saw negative return rates, with the worst return rate of negative 36.84% in 2000. Recently, the Nasdaq 100 has been growing again thanks to AI and other technology companies. Last year, in 2025, the Nasdaq 100 grew by 30.64%, and over the past 5 years, it has basically doubled, grown by 101.17% in total, to be precise. Compared to other popular indices, the Nasdaq 100 also holds up well. Let's look at the S&P 500, for example. Keeping in mind that the S&P 500 does have a lot more companies than the Nasdaq 100, including many old-school industrial companies, but also financials, the S&P 500 has a market cap of around $68.9 trillion, while the Nasdaq 100 has a market cap of approximately $41.54 trillion. The S&P 500 is considered more stable for long-term investors and growth, with a lower risk profile than the Nasdaq 100, because it is more diversified, meaning it includes more firms from different industries. The Nasdaq 100, with its focus on technology, has higher risk, but it can also give potentially higher yields, as I've shown already. But investors must decide for themselves if they are willing to accept this risk. So, as you can see, the Nasdaq 100 is not only an important index for tracking the stock market, but may also help you grow your money over the long run through investments into mutual funds or ETFs that follow the Nasdaq 100. So, what do you think about the Nasdaq 100? Did you know about its history, or were you surprised about it? And maybe you already own a few shares in a Nasdaq 100 fund like many of us do? Drop a comment and let us know. And make sure to like and subscribe if you learned something new or found some of our tips helpful. And check out this video here on the S&P 500 if you want to learn more about investing and how to grow your wealth. Thanks for watching, and we'll see you again next time.